we talked about that the first step is to figure out when you have partnership debt, whether any partner bears the economic risk of loss with respect to the debt or portions of the debt. So that's the economic risk of loss. That's 1.72-2 reg, and we saw the process for that. And to the extent the debt is apportioned under that, then that partner gets that share of the debt. Remember, if the partner's share of the debt goes up during the year, that's a constructive contribution of money, increases that partner's outside basis. If the partner's share of the debt goes down, that's a constructive distribution, reduces that partner's outside basis. If we still have liabilities remaining after we've done the economic risk of loss analysis, whatever liabilities that are left are determined to be what they call non-recourse liabilities and are apportioned under 1.72-3. So let's turn to that reg now, -3, 1.72-3. And it's a pretty straightforward set of rules. I mean, it's not long, and it's just a 3-tier approach. So -3A right here, a partner share the non-recourse liabilities, and that's defined as all liabilities that were not, for which no partner bears the economic risk of loss, whatever's left after we do -2. And we have tier 1, we're going to give each partner their share of partnership minimum gain. The partner's share of partnership minimum gain. Now you can see why we had to come back to 752. Because in order to fully explore this, we have to know, well, what's partnership minimum gain? Well, we've already learned what partnership minimum gain is. We'll have a refresher course today, but it generally means that the allocations of non-recourse deductions previously allocated to that partner. Non-recourse deductions are the ones for which the lender bears the economic risk of loss, bears the economic burden of those deductions, right? When the book value of the property falls below the basis, the amount of the debt, those deductions are no longer represent burdens of the partners, because that loss, to the extent it exists, would be borne by the lender, who would eat that loss. So it's a good refresher course. We'll come back to that. But tier 1 is the partner share of partnership minimum gain. Tier 2 then asks a hypothetical question, and this is, we can call this minimum 704C gain. And it says, to the extent we have 704C property, what's 704C property? It's property that has a book value different than its basis. Usually it's contributed property. And if that 704C property secures a non-recourse loan, then we ask, well, what if we sell that property for the amount of the non-recourse loan and nothing else? How much gain would be allocated to the partners? And so it's a hypothetical disposition of this 704C property, and we see where would the gain go. So the amount of any taxable gain that would be added to the partner under Section 704C if the partnership disposed of all partnership property subject to one or more non-recourse liabilities and full satisfaction of liabilities and for no other consideration. So that's the minimum 704C gain. Because under the Tufts Rule, if we got rid of the property for 0, we just abandon it, we're going to have that gain because the amount, the non-recourse loan will go in the amount realized. So that's what we can call minimum 704C gain. And it asks that hypothetical question. So that's tier 2. This is all extremely abstract, I know, and so we'll get quickly into a problem to see how it works. But tier 3 says you determine in accordance with the partner's share of profits generally. And there's all sorts of alternative rules here, but we're going to focus on that, the share of the profits. And then importantly, well, that's a facts and circumstances test. What does it mean, how you share profits? That could be complicated in some, or uncertain in some situations. But then he says here, this third sentence, that the partnership agreement may specify the partner's interest in the profits for purpose of allocating these tier 3 liabilities, provided that they're reasonably consistent with allocations of other significant item of partnership income or gain. So we have some electivity here, and we'll see how that works. So tier 1 is the share of minimum gain. Tier 2 is your minimum 704C gain. Tier 3 is share of the profits, which can be specified subject to sort of a rule of reason. And we'll talk about why. I mean, it's a big question about why. I mean, one thing to keep in mind here is that because these liabilities are such that no partner bears the economic risk of loss, there's something artificial about giving them to anybody. The tax law, though, allows you to get basis for non-recourse debt, non-debt that you may never have to pay back. So once you buy into that approach, then you got to, unless you're going to treat partnerships more harshly and not allow them to do it, even though individuals could do it, then you've got to have some method for apportioning. And we're going to see that, like with Dash 2, this is a pretty taxpayer-friendly approach. It tends to give outside basis to those partners who would most likely need it. So that's where we are. You see very short rules. It's just a lot of jargon. So any questions on that before we get to the problems? All right, so let's go to the problems. We're here now on problem 2. So again, this is a nice review of minimum gain. And so we have G and L here. G is contributing cash of 90, L is contributing cash of, G is contributing cash of 10, L is contributing cash of 90. Partners is going to borrow another 900 on a non-recourse basis from a lender. They're going to take that $1 million and they're going to buy a building. The building's going to be depreciable straight line over 20 years. G has to restore deficits. L doesn't. The agreement contains that qualified income offset. And they're going to share profit and loss 90% and 10% to L and G until it reaches profitability overall, and then 50-50. So we have this sort of flip arrangement. Early losses allocated disproportionate to L, early gains allocated disproportionate to L. Once you hit the point of overall profitability, all future gains and losses allocated 50-50. And the partnership agreement here specifies that for purposes of allocating non-recourse liability, excess non-recourse liabilities, that's tier 3, that they're each going to get 50-50. So we're going to run through 3 years and see what happens in the first 3 years. So starts out pretty simple. So we've got G, we've got L. We put the capital account, so that's a book capital account. We don't have need any for a tax capital account. We don't have any 704C property. So just put capital account and outside basis. And so G contributes 10 and L contributes 90. We've got the non-recourse debt here of 900. We buy the building. It's got a book value of $1 million and inside basis. The thing we have to deal with now is we have to, because we have debt on the books, we have to determine each partner's share of that debt. So we're going to have a, if we have this line here, this is section 722. Then we're going to have a line here, 752A and 722, because we're going to have a deemed contribution. Where does that debt go? Is it all G's, all L's, split? How do we do it? So we got to go through the -2 analysis first, figure out, does any partner bear the economic risk of loss? So let's go back to 1.72-2 for a second, tie up a loose end there. With 752-2, we have that atom bomb scenario. Where everything becomes worthless. Here's our, this is -2, B1. We saw this yesterday. Liabilities are due and payable. Everything becomes worthless. The partnership disposes of all of its property in a fully taxable transaction for no consideration, except relief from liabilities for which the creditor's right to repayment is limited solely to one or more assets. So that describes us, that parenthetical, because that building is secured by the non-recourse loan. So we're not going to dispose of it for no consideration. Instead, if we go down to -2B2, 1i, it tells us if the creditor's right to repayment is limited solely to one or more assets, gain or loss is recognized in an amount equal to the difference between the amount of the liability extinguished and the tax basis of the asset. And then, oh, by the way, if we have 704C property where we have book value differing from tax basis, then we use book value. So this is the Tufts Rule. This says, okay, we're not going to, the building is now worthless, but because it secures a non-recourse loan, when we dispose of it, the non-recourse loan goes in our amount realized. So in this hypothetical transaction, our loss, we have an amount realized of 900 on this hypothetical. And our adjusted basis is 1,000. So we have a 100 of loss. If this were a recourse loan, in other words, if the creditor had not limited its right to repayment to one or more assets, then there would be $1,000 loss, or $1 million loss, depending on what we're doing here. So it's 100 of loss. So that's the loss that we realize on this hypothetical sale. We allocate the loss, again, hypothetically. So I'll put it in red because we're not actually doing this, but just for purposes, we allocate the loss. Well, it goes 10% to G, 90% to L. So G's capital account will be 0, L's capital account will be 0. And then we see everybody sues everybody. The lender comes knocking and says, where's my money? And G and L don't have any negative capital account. L doesn't have to kick in a negative capital account, but he doesn't have one. And neither G nor L is responsible. G is a general partner, but it's a non-recourse loan. The lender has limited itself to its only recourse to foreclosure. And so neither G nor L would pay a red cent to the lender. And so this goes to show what we probably intuited, which is that neither G nor L bear any economic risk of loss for this liability. And that's true, again, even if they agree to restore deficits in their capital account. Because under the hypothetical liquidation, they don't have any deficits here. Okay, questions on that? Okay, so all that to tell us that we do not have any recourse liability here. So the entire loan then goes to our three-tier approach. So we got G over here, L. We got tier 1, tier 2, and tier 3. Tier 1, this is from the -3 reg, says the partner's share of partnership minimum gain. Well, let's go back and think about what minimum gain is. Again, I'm not going to show you the reg again, but you can go back and see it. But the reg says you have partnership minimum gain to the extent your book value is less than the non-recourse loan. So another way to say it is the amount of gain the partnership will recognize if you sold the property that secures a non-recourse loan for the amount of the non-recourse loan and nothing else. Well, if we did that, which is what we just did, we'd have 100 of loss. We have no minimum gain at the outset. And typically you won't. You're going to have minimum gain when the property drops, but the book value drops below the level of debt. So we have no minimum gain in year 1. So no partner can have any share of minimum gain. So nothing gets apportioned in tier 1. We'll see that changes in year 3. 2 says the amount of 704C gain that the partners would recognize if they sold the property that secures a non-recourse loan for the amount of the non-recourse loan. Well, here we don't have any 704C. We have a non-recourse loan. It's secured by property, but the property is not 704C property. It has no book tax disparity. These are the same. So there's no minimum 704C gain. So now we go to tier 3. Tier 3 is apportionment in accordance with the share of their profits. Now, if we didn't have an agreement as to how they specified that, there might be some uncertainty. What does it mean to share profit? They're going to share, ultimately, profits will be shared 50-50, but after the years of losses, the early gains will be shared 10-90. So this is 50-50, and there's that reasonably consistent language. Let's go back to that reg. This is the -3 reg. So the only question here is whether the specification is reasonably consistent with allocations of some other significant item of partnership income or gain. And there's nothing really directly on point. We can use, by analogy, remember we had that similar language with the safe harbor for allocating non-recourse deductions. You could allocate non-recourse deductions in a manner as long as they were consistent with the way you allocated some other items. And under those regs, this is 1.704-2, those regs said, if you have this arrangement where you're allocating in a certain way, and then you'll flip to another way once you hit the point of profitability, and if profitability were reasonably likely, that anything in between and inclusive of those two endpoints would be okay. So that would seemingly be fine. This 50-50. As long as you're between 10-90 and 50-50, seems like I would use that analogy. Here, I can just, this is 1.704-2. M, example 1. I don't have to turn there now, but just, it was this -2 M1, 1.704-2 M1 example 1, 2 little i's, and it said, basically this was the upshot, where we had the same sort of 10, 90, 50, 50 flip, anything between those. So bottom line is that the 900, whatever's left, gets split 450, 450. So upon sort of at the outset, each partner's share of the liability is 450 each. So that's as if they contributed 450 of cash each for tax purposes. So their outside basis goes up by 450 each. Okay, that's at the outset. Any questions on any of that? I'm gonna stop there. Any questions?
Yeah, are you choosing 1, 2, or 3, or do you have to do them all and add it together?
You sum them. Yeah, you're summing these together. 3 is going to catch whatever is not picked up by 1 or 2. So 3 is, we'll see that once you get something here, then less is going to go there. And it's always going to sum to 900, the amount of the debt. It's the sum of the 3 tiers. Okay, so let's go to year 1. Year 1, let's assume we just have the depreciation. So it'll be 50 per year. And under the agreement, we're going to allocate it 10% to G, 90% to L, and that's going to have substantial economic effect. Again, no non-recourse, no minimum gain yet. That we have our minimum gain table. We can keep that and keep that here. At the end of year 0, we had no minimum gain. At the end of year 1, we're going to have no minimum gain. If we sold the property for the amount of the book value, the amount of the debt, we'd have 50 of loss, still no gain, because we have 900 debt and 950 of book value. So no minimum gain at the end of year 1. And what that means is that, again, at the end of year 1, has there been any shift in the shares of liability? And the answer is no. There's still no minimum gain. There's still no 704C gain. The only way we'd have 704C gain would be if we have a revaluation, a book up of this property, because it's not contributed property. And then in 3, again, we're going to split it 50-50. So we have no reshuffling of the debt. So G's share remains 450 and L's share remains 450. And by the way, the debt hasn't been paid back in part or in full. And that's the way we'll do it. I mean, in real life, you might have a debt that amortizes like a home mortgage. The debt goes down every year by a little bit. So you'd have some adjustment for that. If you have a balloon note where you're going to make principal payments in lump sum down the road, then the principal of debt will stay the same. And so that's what we're going to assume here. Okay, so that's year 1. Any questions about year 1? Well, year 2 is much of the same. A little bit, we're getting close to L. L can't go below 0, right? L has no deficit restoration obligation. And but L doesn't go below 0. L gets right to 0 to capital account. So and again, these are recourse deductions in years 1 and 2. They're eating through the equity that was contributed. We haven't yet gotten to the lenders portion. And again, at the end of year 2, the minimum gain is still 0. We sold the property for book value, the amount of the debt at the end of year 2, we'd have 900 of proceeds and 900 of book value. The excess is 0. And again, the debt doesn't shift. It's the same. This is still this right here is still the approach. So we have no shifting of the debt. Okay, so then we get to year three. Year three, things get more interesting. So the first thing we'll note is that in year three, now we have minimum gain. The book value is now $850. If we sold the property for the amount of non-recourse loan, $900, we'd have 50 of gain. So we have 50 of minimum gain. Our minimum gain went up from 0 to 50. That generally indicates that we have non-recourse deductions of 50. Under this agreement, we're not specially allocating the non-recourse deductions. So the only thing that shifts is that instead of testing these for substantial economic effect, we're going to test these allocations under the -2E safe harbor. So this is substantial economic effect, substantial economic effect. This is going to be -2E safe harbor, and they satisfy it. Reasonably consistent with the way we allocate other items. Well, we're allocating everything, 10 and 90. So we put this asterisk to indicate that they're non-recourse deductions. And remember, you might say, oh, well, L now goes below 0. L's capital account is -45. Well, your partner's share minimum gain is treated as an LDRO. We remember back that, so it permits L to go below 0 to the extent of his share of minimum gain. So that would be the allocation of the deductions. The thing we now have to think about is year three, does this change the way the debt is shared? And so we go back to our 3-tier here. And now in tier 1, we have 50 of minimum gain. So each partner's share of minimum gain is going to go into their tier 1. So what's G's share of the minimum gain and what's L's share of the minimum gain? Well, just to take a quick detour back to minimum gain, take a quick look at 1.704-2G. 1.704-2G. I wrote that down wrong. Let's see where I am. Oh, there it is. Okay. What is a partner's share of minimum gain? It equals the sum of the non-recourse deductions allocated to that partner. And the sum of the distribution of, sum of non-recourse deductions and distributions made to that partner out of non-recourse liabilities. Reduced by any minimum gain that's been charged back through a minimum gain chargeback. So in this fact pattern, it's just the sum of the non-recourse deductions. We had no distributions of proceeds of non-recourse liability. We had no minimum gain chargeback yet. And so each partner's share of the minimum gain is their allocation of non-recourse deductions. So that means that G's share is 5, sorry. G's share is 5 and L's share is 45. That's this for G and this for L. There's still no 704C minimum gain because we don't have 704C property. Now when we get to tier 3, we've allocated 50 of the debt here, so we only have 850 left. So the 850 is split 50%, 50%, so that's 425, 425. And so that means G's share is 430 and L's share is 470. So G's share has gone up. I'm sorry, G's share has gone down by 20 and L's share has gone up by 20. So that's a deemed contribution of 20 by L. So L's outside basis goes up by 20. Deemed distribution of cash to G. So G's outside basis goes down by 20. And that's what happens. So any questions about what happens? I'm gonna explain sort of why in a second. But any questions on what we've done? So this is because tier 1 is allocated 1090. Tier 3 is allocated 50-50. Once we get to have allocations in tier 1, we're going to have shifts every year. So what's going on here? Well, if you think about it, if this keeps going, L is going to need to have more outside basis to get all these losses. And L eventually is going to get these back, at least these back here, through the minimum gain chargeback. It's just temporary. And so L, to get the benefit of those, he needs to have enough outside basis to absorb it. He's getting 90% of these deductions. J's only getting 10%. G doesn't need all that basis. And so what happens is, as L gets allocated more non-recourse deductions, he gets more of the debt, which allows him to then use the non-recourse deductions and not be harmed by 704D. Remember, which says you need enough outside basis to absorb. So one way to look at that, just to show that, is let's just do years 4 through 20 in one line. So what happens in years 4 through 20? We're just going to multiply everything by 17 because we got 17 years left. So if we run this building out through its depreciation schedule, there's going to be a total of 17 times 50. There's going to be 850 of deductions, depreciation, and 85 is going to go to G, and 90%, which is 765, is going to go to L. And G's got plenty of outside basis to absorb that here because of this big chunk right here. L, if there wasn't any shift, L wouldn't be able to get it. L would be in a negative basis situation. If we add this all up, L's negative basis. But what ends up happening also is this is dash 2E, the non-recourse deductions. These are all non-recourse. What also happens years 4 through 20 is every year 20 is going to shift from G to L. So we're going to get G's outside basis is going to go down by 140. That's 17 times 20. I'm sorry, 340. 17 times 20. And L's basis is going to go, outside basis is going to go up by 17 times 20. And then we sum that together. The beauty of that, particularly for L, is L's outside basis is going to end up at 0. That's going to allow L to claim all of these deductions. G's is also going to end up at 0. So we've sort of given the outside basis to the partner who needs it. The partner that's getting these non-recourse deductions needs to have outside basis to use them. So you're giving it to that partner. So when a partner has a share of minimum gain, that means they're allocated non-recourse deductions, or they've been distributed non-recourse debt proceeds, which you'd also need outside basis for that to avoid gain recognition. So these rules, again, they're working, sort of saying like, geez, getting a whole bunch of deductions here. So let's give him more outside basis so he doesn't run into 704D. That's effectively what is going on here. So at the end of year 20, G's capital account is negative 90. L's is negative 810. That equals their share of minimum gain. G's share of the debt is 90. And that's why G's capital account is 0. L's share of the debt is 810. That's why L's outside basis is 0. Questions on this? You don't really have to fully appreciate this, piece. I mean, this is just running it out to show you why. I mean, again, the technical stuff is really here. And it's really idiot proof. I mean, the thing is that G and L probably shouldn't have a portion specified it to be 50-50. That gives G way more outside basis than he needs and gives L too little. But it's kind of idiot proof because even if you make that mistake, we're still going to give L more of the basis as he gets allocated non-recourse deductions. So it's kind of idiot proof. Okay, questions? The only reason why this is tough, I think, is because it's, coming back to minimum gain. And minimum gain is tough and jargony. But the nice thing here is once you get minimum gain, the concept in your head, then this becomes pretty easy stuff. Minimum gain, your share of the minimum gain is non-recourse deductions that were previously allocated to you and distributions of cash of non-recourse debt proceeds that you previously received. We haven't done much on the second. We've done a lot on the non-recourse deductions piece. All right. Let's go back to the problem. So we did A and B. We go to C. Well, what if the tier 3 had been allocated 90-10? This is where we're like not an idiot. We kind of realized this and we're going to do this the right way. Well, what happens then is that things are simplified. Number one, our initial share of the debt is going to be 10% to G and 90% to L. And then when we start shifting, once G starts to have tier 1, once they start to have tier 1 allocations, their tier 1 allocations are going to be allocated in the same ratio as a tier 3. And so you no longer will have any of this shifting. So this will go away. You won't have that. G share will always stay at 90. L share will always stay at 810. And so everything's the same except you don't have the shifting. And again, L never gets below 0, never has a 704D problem, and nor does G. So it just simplifies things. And that's probably the way they should have done it at the outset. Again, because L is the one who needs more of the outside basis because L is getting disproportionate amount of the non-recourse deductions. But even if they screw it up, again, it's going to work out okay. Okay, questions on that? All right, in D, I'm not really all that worried about D, E, and F. Just go through it really quickly. Again, A, B, and C are by far the most important things in this problem. So if the debt is guaranteed by G, who has no reimbursement from the partnership, then we go back. What ends up happening then is we no longer have a debt where the lenders can solely look to the creditor, can solely look to the property. Now the lender can sue G on his guarantee, and the buck's going to stop with G. And so what's going to happen then is that all 900 of the debt is going to go to G. So G would be apportioned to all 900 of the debt. And well, we can just run that through really quickly here just to show you. We no longer have any non-recourse deductions, any non-recourse liability. And so what's going to happen, under just the economic risk of loss concept, it's going to all go to G. In the hypothetical liquidation, we now have a loss of 1,000 because we're selling it for 0 because it's no longer non-recourse. I mean, it's non-recourse, but with a guarantee there. So it's no longer effectively non-recourse. So they allocate the loss. The loss will be allocated, under the agreement. It looks like it'll be allocated 100 and 900. So L has a negative capital count of 10 and G has a negative capital count of 90. G's gonna have to kick in the 90 because G's has to restore. L doesn't have to restore. G's gonna then be called pursuant to his guarantee to pay the remaining 810. So G's gonna bear all 900 of the economic risk of loss. So it all goes to G. And we go to year 1 and year 2. It's the same as before. And in year 3, and we haven't really gotten into and we hadn't done what's called partner non-recourse debt. So this is what would be considered a partner non-recourse deductions, but you can intuit that the deductions in year 3 have to all go to G. Because L is tapped out, has 0 capital account. L can't go below 0. G can, because G is going to have to kick into the lender. And so G ends up being at negative 50 here and 850. And again, it's just showing you that the debt is going to the partner that needs it. G is the one who's going to ultimately be able to claim those deductions when it goes, the property book value goes from 900 down to 0, because G is the one who's going to get them. So, but again, all I think you need to know is that when you change that fact, now that G is responsible under the guarantee, that G now bears the economic risk of loss for the debt, so the entire liability goes to G. What if G has a right to reimbursement? Well, that's kind of silly. I mean, it doesn't change anything because G, the only general partner is G, and so G would have a right of reimbursement effectively from himself, so it wouldn't change any fact pattern, any result. If G is poor, generally you don't take into account the financial solvency in these rules, so we don't have to worry about that. And then E, if the debt is guaranteed by L, L has a right of reimbursement. then again, it's really a question of state law. It's a non-recourse debt that's guaranteed by L, and then L can sue the partnership. I would presume that general partner would then be liable, but I'm not sure exactly how that would work. Ultimately, that's the question, is who would end up holding the bag at the end of the day. And I'm not sure exactly how that would work. If G is a non-recourse lender, then there's rules that say when the partner is a non-recourse lender, then you get the debt. I mean, because you're bearing it in your capacity as a lender. You would get the debt, and you would also get those non-recourse deductions. Again, don't worry at all about D, E, and F. Let's focus on A, B, and C. Okay, any questions on any of that before we move on to 3? Okay, so 3 was a problem. We did a bunch of this yesterday, and we changed one fact in B. We did A, we changed one fact in B, and the big fact is it's non-recourse instead of recourse. So if you recall, just starting from the top, what we had in this fact pattern is, all right, we started off, we had A and B each contributing 150 of cash. So our book capital account, tax capital account, and outside basis are all 150 to start. They bought property number 1. Let's make this land number 1. Land is not depreciable, so it makes it easy. And so they buy it for 300. And then C is going to be admitted to the partnership later on after the property went up in value to 800. So because C is being admitted to the partnership by contributing property, the partnership will book up its assets to fair market value. So this gets booked up to 800. By the way, you know what the assets are worth, because you can extrapolate that if C is willing to put in 400 of value to get a 1/3 interest, that means the existing value must be worth 800. So these book up events have an element of rationality to them, right? Where the value really means something. You can imply the value based on what arm's length partners are agreeing to. So the property is worth 800. So that's 500 of book gain. We're going to allocate the book gain. A and B are 50-50 partners before C comes in. So they'll get allocated 250 each. So that's our book up. No tax consequences. So no tax allocations, no outside basis adjustment. Okay, then C comes in and contributes property number 2, and it has a fair market value of 700 and a basis of 150. It's subject to a non-recourse debt of 300. So C's contribution, book capital account goes up by the net value of property contributed, 700 less 300, so that's 400. C's tax capital account goes up by the net basis contributed, 150 less 300, negative 150. C's outside basis starts with the carryover basis of 150. That's per section 722. But then we have to deal with the fact that the debt is coming off of C's books. So C's individual liabilities are being reduced by 300. So under 752B and 733, 752B says it's a constructive distribution of money. 733 says distributions of money reduce outside basis. Now the only thing that's left is we have to figure out what each partner's share of the partnership liabilities is, because before the debt, each partner had 0 share of partnership liability. There was 0 liability. Now there's 300, and that's going to be shared in some capacity among the partners. So we have to go through the 752 analysis. So let's do that. And let's start again with economic risk of loss. So property 1 is deemed worthless. We sell it for 0. So we have 800 of loss. And by the way, I mentioned this before, mention it again, that this economic risk of loss, if the book value and tax basis differ, which they do here for both these properties, for the economic risk of loss analysis, you're using book value. So we're selling number 1 for 0. We have 800 loss on the sale of number 1. Because the non-recourse debt secures 2, we sell number 2 not for 0, but for 300, the amount of the debt. That's the Tufts Rule. So we have a 400 loss on number 2. Amount realized of 300, book value of 700, we have a 400 loss. So we have 1,200 of total losses that we allocate among the partners. 1/3, 1/3, 1/3 under the partnership agreement. And each partner's capital account is 400. So there's no negative capital account balance. So even if the partners have to restore negative capital account balances, they won't. And under state law, they don't have to kick in any money because it's a non-recourse debt. And so all that to show that none of this debt is a recourse debt under 752. It all is a non-recourse debt under 1.72-3. And so we have to go to our 3-tier system. Okay, does everybody understand that? So we just applied 1.72-2 and got nothing out of it, basically. Nothing. No debt was apportioned under -2. It's all under -3. So we go to the 3-tier system. So tier 1 is the minimum gain. Well, do we have any minimum gain? Remember, partnership minimum gain exists where if you sold property which secures a non-recourse loan for the amount of the non-recourse loan, how much gain would the partnership recognize? Well, the amount realized would be 300. The book value is 700. That's a 400 of loss, not a gain. And just like with the economic risk of loss concept, minimum gain, if there's a book tax disparity, you use book value, not tax basis. That may be something new we haven't focused on yet, but that's the rule for minimum gain. Because I think we've done minimum gain where we didn't combine 704C with it. So we have no minimum gain in the partnership at the outset. So we go A, B, and C, there's nothing there under tier 1. There's only minimum gain when the debt is greater than the book value. Here it's not. Okay, so we go to tier 2. Tier 2 says, all right, what if we sold this property for the amount of non-recourse debt? How much 704C gain would be allocated to the partners? So this is hypothetical sale of 704C property. This is why we had to do 704C before we could do allocation of non-recourse debt. So it's a review of 704C. What if we sold it? And I'm going to put this in red because we're not actually selling this, but what if we did? Step 1, determine our book and tax items. For book, our amount realized is 300. Our book value is 700. 400 of book loss. For tax, our amount realized is 300. Our adjusted basis is 150. So you have 150 of tax gain. So then we allocate the book loss, 1/3, 1/3, 1/3. Then we give A and B, the non-contributing partner, with respect to property number 2, we give A and B tax loss equal to book loss, but the ceiling rule comes into effect and says we don't have any loss to give them, so we can't give them anything. Step 4, whatever's left goes to contributing partner, which would be 150, would be C. So C would get 150 of tax gain. Under the traditional method, we just stop there. So we just stop there. And so the answer in tier 2 would be the amount of 704C gain that we allocated to the partners. If we sold property 2 for 300, the answer is C would get 150. A and B would get 0. And then step 3 is our share of partnership profits, which here is pretty simple. It's a straight away 1/3, 1/3, 1/3 partnership. So we've got 150 of the debt left. We have a total column here. So it's going to go 50, 50, 50. So A's share is 50, B's share is 50, and C's share is 200. A's share is 50, B's share is 50, C's share is 200. So what does that mean? That means when we go here, C gets 200, B gets 50, and A gets 50. And remember from yesterday, we net these together. So it's a net distribution of 100, and C has enough outside basis to absorb, so there's no gain. And C's outside basis ends up at 50. So immediately after the contribution, the books of the partnership look like this. Okay, so that's the answer to B. I'm going to again step back and explain why this makes some sense. But technically, does anybody have any questions about technically what we've done? So why? I mean, this is again taxpayer friendly. If you recall, when this debt was recourse, what we did on Monday, C ended up with 50 of gain, because this was split 100, 100, 100, and there was a distribution of 200 in excess of 150 of basis. So C had that gain, and that's a bad result. C doesn't want to have that gain. That's acceleration of income. We want to defer income. We don't want to accelerate income. So what these rules do is it says in a case like this where C is contributing appreciated property subject to a non-recourse debt, it's reducing the likelihood that C is going to recognize gain on the contribution. It's going to give C more of the debt under tier 2. which is going to reduce the impact, the likelihood of him recognizing gain, and the impact of any such gain. So again, it's kind of going where you want it to go. A and B don't really need that extra basis. C's the one who needs it, and so it's sort of instrumental in that way, giving it to the partner who most needs it.
I have a question.
Yeah.
In tier 2,
Yeah.
when we're determining book and tax items, and then we're adding book loss, like a third each,
Yeah.
we're not actually caring about what that book loss is. Like, it doesn't make it to the final analysis, right?
Here it doesn't, but what if we had used remedial? What if there was a remedial allocation? So if we had used remedial, let's go back to that. So that's a good question. But before we get to that, I'll change the one fact. I'm going to make it remedial. But any questions on anything before we get to change the fact pattern? Any questions on this? So if it were remedial, what would end up happening, and we got A, B, and C here. Again, nothing under tier 1. Under tier 2, again, I'll put this in red. And what we would have done, again, the book would have gone, it's hypothetical. It's not actually happening. It would have gone 133, 133, 133. And step 4 was 150. Well, then under remedial, we would give another 133 of tax. That would be a remedial line, 133 here. And then we'd have the flip side, 266. So we'd end up actually, if it was remedial, C would end up being allocated 416 of gain if we had sold it for the amount of non-recourse debt and no more. And so we'd get, now you wouldn't give C 416, we only have 300 to give. What would end up happening if it was remedial is that C would get all 300 of the debt, and there'd be nothing left under tier 3. So you're right, under traditional, it doesn't really matter what the book allocation would be here. But again, you can imagine a book allocation that's positive. And so I would just run through it the way I just did. I mean, you run through a hypothetical 704C and say how much gain would be allocated to each of these partners. Here, you're right, under traditional, that was kind of a step that didn't have a significance, but it can have significance again. If you end up with remedial, really is going to be the way. Okay, so if it's remedial, the change would be, this would end up being 300, and this ends up being 0, 0. You're effectively giving C this advanced credit for this 704C gain that he's ultimately going to recognize. Okay, let's just do one other simpler problem. This goes back to problem on page, I think it's 55 of the partnership tax book and 71 of the combined book, but it's a really simple fact pattern. So we can it's simpler than this, but it's the same idea. So we had, in that problem, we had A and B each contributed cash of 30. And C was contributing land with a fair market value of 60 and start out with a basis of 40. We're going to change that in a second. And that was subject to a debt of 30, non-recourse. So B's book capital account would be 60 less 30, which would be 30. Tax capital account is going to be 40 less 30, which is 10. C's outside basis starts at 40. And then under 752B, he's shedding 30. And the question is, how do we share this debt among the partners? And the answer is there's no minimum gain. Our book value exceeds our non-recourse deduction. And there would be no minimum 704C gain, because if we sold this property, we'd end up with a loss, not a gain. Sold it for the amount of the debt. So it would end up being split under the way we share profits, which would be here in a simple 1/3, 1/3 would be such. And by the way, that's the answer if this is a non-recourse debt, or, which is, we didn't go over this when we did it back then, we stopped. If this were recourse, you go back to your notes, it's still split 10, 10, and 10. But let's just change one fact, and let's make it this outside basis, this base is 10. So now the basis is 10. And if the debt were shared like this, we'd have a distribution of 20, net distribution of 20, with a basis of 10, we'd have 10 of gain. And that was the result when this was recourse, and the basis was 10. So going back to that problem, we did it where the basis was 10, and it was recourse, and C ended up having 10 of gain. But now let's make it non-recourse. And again, so now we go to the tier 1, tier 2, and tier 3. Well, we have no minimum gain. Again, minimum gain is where the non-recourse debt exceeds the book value. We don't have it here, so there's no minimum gain. Minimum 704C gain would again say how much if we sold this property for the amount of the debt, how much 704C gain we allocated to the partners. So we'd have again 30 of book loss, $30 minus $60, and 20 of tax gain. So again, we would allocate the book loss. We'd give A and B tax loss equal to book loss, but ceiling rule, whatever's left goes to C. And then again, if we had remedial, we do a further step. Let's assume there's no remedial. So what would end up happening then is under tier 2, C gets 20, A and B gets 0. And under tier 3, we've got 10 left, and we go 3.3 across the board. So C's share is 23.3, B's share is 3.3, A's share is 3.3. And so to complete the picture, A's outside basis, I'm sorry, C's outside basis goes by 23.3, B's by 3.3, C and A's by 3.3. And again, for the most significant piece of this is that C doesn't have to recognize any gain on the contribution because he has a net distribution of 6.6, but he has 10 of outside basis to start. So his outside basis ends up positive. So that's the way the books look afterwards. Just compare again, you go back to your notes, go back and compare where this were recourse. C recognized 10 of gain, because this was 10 rather than 23.3. So it's another illustration of why this tier 2 is taxpayer friendly. It's protecting the contributing partner from recognizing immediate gain. But anyway, you should go back. It's a simpler problem than what we did. We didn't have a book up. And like, oh, I didn't do, I know I skipped a part of the problem. Let me go back to the problem. So we'll have to come back on Monday. And we'll do C. So on Monday, we'll do C, which is just more of the same on the same problem, a little bit more, another spin on that. And then problem 4 is we can go through that quickly. It's not really all that significant. So we'll finish 3C and then we'll go to 4. I will say that I think I'd said that minimum gain was kind of like the lowest of the low. I mean, this is getting back into that stuff, so it's hard. We kind of come up for air that the next set of assignments is a lot simpler. So we'll get a breather from some of this stuff. So the next topic is going to be sale of partnership interest. And so that's, again, a nice break. Probably the easiest sort of big set of material we'll do all semester long. Not to say it's easy, but it's certainly easier than the stuff. All right, so that's the plan. Any questions about any of this? Okay, I'll see everybody on Monday. Bye-bye.